Welcome to Speidel's Federal Tax Minute. I'm your host, Catherine Zidane. This week, we're covering 4 important depreciation provisions contained in the One Big Beautiful Bill Act. For a more in-depth discussion of this bill, sign up for Speidel's 2-hour on-demand webinar, Understand the New One Big Beautiful Bill Act. You can get details and register at speidel.com under webinars. OBBBA contains 4 important depreciation provisions with the following changes. It reinstates 100% bonus depreciation. It creates a new class of qualified production property that is eligible for 100% bonus depreciation. It increases IRC Section 179 expensing limits, and it temporarily reinstates the exclusion of depreciation, amortization, and depletion in the adjusted taxable income calculation for business interest expense limitation purposes. OBBBA extends 100% bonus depreciation permanently for property acquired after January 19, 2025. A special transitional election is available for taxpayers only in the taxpayer's first taxable year ending after January 19, 2025. The special transitional election allows taxpayers to elect to use the 40% bonus depreciation rate for the transition year, or 60% for longer production property. For calendar year taxpayers, the transition relief year is the 2025 taxable year. OBBBA also expands the definition of qualified property eligible for bonus depreciation to include qualified sound recording production costs placed in service, which is defined as the time of initial release or broadcast, applicable to productions commencing in taxable years after July 4, 2025. And it expands the special expensing rules for qualified film, television, and live theatrical productions under IRC Section 181 to include aggregate qualified sound recording production costs of up to $150,000 per taxable year. However, this latter provision only applies to qualified sound recordings that commence in taxable years ending after July 4, 2025 and prior to January 1, 2026. To qualify, the recordings are required to be produced and recorded in the U.S. It does not include sounds accompanying a motion picture or other audiovisual work. OBBBA creates new IRC Section 168 subsection N, which allows an elective 100% bonus depreciation for qualified production property. Qualified production property is defined as the portion of any non-residential real property that meets specified requirements. The term qualified production activity means the manufacturing, agricultural, or chemical production or refining of a qualified product. A qualified product is any tangible personal property. Qualified production property specifically excludes the portion of any non-residential real property used for offices, administrative services, lodging, parking, sales activities, software engineering activities, or other functions unrelated to the manufacturing, production, or refining of tangible personal property. OBBBA allows 100% bonus depreciation for used machinery and equipment, similar to the TCJA provision allowing bonus depreciation for used property. And OBBBA increases the maximum IRC Section 179 deduction to $2.5 million and increases the phase-out threshold amount to $4 million, effective for property placed in service in tax years beginning after December 31, 2024. These amounts will be indexed for inflation beginning in 2026. Currently, the maximum inflation-adjusted deduction for the 2025 taxable year is $1.25 million, and the phase-out threshold is $3.13 million. Attend Speidel's Federal Tax Update webinar and get updated on everything that happened during the year to be ready for filing season. See a list of topics covered and get registered at speidel.com under webinars. That's all for this week. Join us next time for another episode of Speidel's Federal Tax Minute.